Okay, good evening, everyone. Welcome to the second class on my topic of corporate and economic laws and the CA final, where today we are going to cover miscellaneous provision. And there was some technical issue at ICI level, so sorry for the delay. So let us straight away start with this concept. Yes, as I've been discussing in my previous lecture, all these small topics of winding up, miscellaneous provisions, IBC though is the main component today, but other topics which I'll cover, NCLT, SEBI, these are small topics but then very relevant, and these are topics of such nature where you will get direct questions in the exams. So today we'll be covering dormant and strike-off companies, registered valuer, and something in relation to government and companies. Nidhi companies, I'll take it up later when we'll be covering NCLT and compounding part. So these are the topics to be covered. That will take most of our times, and nature of question, it is mixed, case-based also. But yes, even if it is case-based, I think it will not be complicated, because you won't find much of complication out here in comparison to other topics. Coverage, as I said, around 4 marks, minimum 4 marks, and we all understand the importance of 4 marks. So let us straight away start with the topic of valuation, friends. Valuation, a very new concept introduced in the Companies Act from 2018, effective from 5th February 2019. So that means it has been 4 years since this particular section, and relevant provisions and regulations have been notified. And again, a big opportunity for chartered accountants as a valuer, registered valuer. I myself am a registered valuer and insolvency professional. So I can vouch for it that yes, it has opened up new gates for all of us as chartered accountants, new areas of working professionally and consulting. So please read the sections and the relevant regulations very carefully. There are more to it for once you become a chartered accountant, because you have to clear certain exams. Anyway, so we have section 247. The provision regarding registered valuer is only 247, but then there are rules attached to it, so we need to refer to the rules also. If we consider valuation and the various other laws, you'll find that the whole world of valuation is altogether a different domain. And be it Companies Act, leave aside Companies Act, I think, be it FEMA, be it Income Tax Act, be it SEBI, be it IBC, be it SARFAESI, RBI guidelines, INDES, and various other court requirements. There are so much attached to the world of valuation. So friends, looking to this particular slide, we can understand that under various Act, there are so many transactions which are happening which will require valuation report to be taken from a registered valuer. Coming specific to the world of Companies Act, so we have section 247 of the Companies Act, which is a very small section, clubbed with the various registered valuer valuation rules, which we have to see. And then we have the valuation standard, obviously not part of your course. We'll cover only 247 and the various valuation rules. So as of today, if you ask me what are the provisions which apply to registered valuer apart from Companies Act, we have SEBI regulations and Insolvency Bankruptcy Code. Under Companies Act, if you see, there are various provisions which call for or which mention the word registered valuer. The first and the primary one is 62, which talks about whenever company is raising funds through issue of shares, or either for cash or for consideration other than cash, then a registered valuer report has to be taken. Then we have section 230, where we have to take a valuation report of the shares and the property of all the assets and tangible, intangible. So that's another section which talks about valuation report from a registered valuer. Then we have 232 again, which talks about merger and amalgamation. So a valuation report has to be taken under section 232. There's a 281 under winding up, which we have seen, where a valuation report from a registered valuer has to be taken when a report has to be submitted by the liquidator, which we have discussed previously. So a valuation report has to be taken from a registered valuer. Apart from this, there are certain regular rules which mention about valuation report. That is section 42 also, private placement of shares, talks about valuation report. Then issue of shares under sweat equity, that also calls for valuation report. Then recently I've seen that under buyback also, or under ESOP also, companies are taking valuation report, though it is not mandated under the Companies Act. But yes, there are 4 or 5 sections which refer to the requirement of valuation report. Major one is 62 section, where whenever there is further issue of shares, when the company has to raise more funds, they have to get a valuation report whenever they file at the ROC. So 247, it talks about that whenever we have to valuation of shares, debentures, securities, goodwill, other assets, stocks, property, then it says that valuation has to be done by a person having such qualification and experience. So qualification and experience are defined under rules, under regulation. It has to be registered, the person has to be registered as a valuer. So that means a person who is registered as a valuer, having such experience and qualification, which we'll understand, he is a member of an organization recognized, and the terms and conditions which are prescribed by the regulation, and is appointed by the audit committee or in its absence by the board of directors. So that means 247 mandates that valuation has to be done by a registered valuer, and these are the criteria of registered valuer. So students who have logged in, they can just send a message also, so that I understand that the name people who are being logged in from various parts of the country. Then subsection 2 talks about, first is the condition, 247, who can do valuation. So it has been defined. Further, we'll understand the qualification and experience. What he's going to do, the duties and obligation of the registered valuer. He will make an impartial, true, and fair valuation. That's the important part. Fair valuation. And that's what valuation standard talks about, doing a fair valuation. How do we do a and not undertake valuation of any asset in which he has a direct or indirect interest, or becomes so interested anytime during a period of 3 years prior to his appointment or 3 years after the valuation of asset was conducted by him. So fair valuation, due diligence is basically an obligation casted upon the valuer. More important part, he will not undertake valuation in which is a direct or indirect interest. Now, what is a direct, indirect interest? Probably if you are an auditor of that company, you cannot do a valuation of that company. Internal auditor of the company, director, independent director, then you cannot do a valuation of that particular company. Or even if your partner is signing, if your relative is a director, shareholder, whatever the case may be, then you cannot do a valuation. 3 years prior to the appointment, or once the appointment is done, then you should not undertake any assignment in that particular company. So to ensure independence, that is why this particular obligation has been casted. If there is a violation of this particular section, then obviously a fine will be imposed, and plus there could be an imprisonment, where the intention is to defraud the company or its members. Intention is to defraud the company or its members. And if convicted under section 247(3), he shall be liable to damages to refund remuneration received to the company and pay damages to the company or any other person for loss arising out of incorrect or misleading statement of particulars made in his report. Very important, friends. So punishment, damages, along with whatever valuation you have done. So it should be taken as a serious note. And if you are causing any harm to any person, then remember there's a punishment and damages to be paid. So 247 is a very simple section, no complication involved. First, it lays down the people who can do the valuation. Second, the duties and obligation. Third and fourth is the punishment and damages. Simple question. So where a registered valuer has been convicted under section 247, then is liable to pay the refund of remuneration, pay for damages caused to the company or to any other person because of valuation report, both A and B, or none of the above. We understand it is both A and B. A valuer under this section will make an impartial, true, fair, impartial, true, and fair. Very easy one. It is impartial, true, and fair. Now let us go through the rules. That is important. The rules for valuation. So there are about 21 rules. I will not discuss all those 21 rules. We'll just focus on the prime major rules which are important. Okay, the rules will apply for valuation in respect of assets and liabilities both. Assets and liabilities both. Now, something to be understood here. Conceptually, we should be very clear. So there is an authority defined under section 440, 458 of the Companies Act to perform the function under this rule. So as of today, the authority is IBBI, Insolvency Bankruptcy Board of India, which will be the governing agency for the registered valuers. So as a registered valuer, we will be governed by IBBI. And a registered valuer can be of three asset class. Land and building, plant and machinery, and securities and financial asset. Three types of valuers will be recognized: land and building, plant and machinery, and securities and financial asset. We as chartered accountants can qualify as a security and financial asset valuer. Now, what does security and financial asset valuer means? Valuing any share. So if you have to value shares, then you require a SFA valuer. Now, the whole structure is that I, as a chartered accountant, should have the required qualification and experience, first condition. Should pass an exam. Before pass an exam, I should undergo a training of 50 hours with an institution known as RVO, Registered Valuer Organization. So I have to undergo a training under a RVO, Registered Valuer Organization. And what is an RVO? It is an organization recognized under Rule 13.5 under the company's registered valuer rules. So they should be recognized under 13.5. I as individual will become a member of RVO, which is further a member will be governed by IBBI. I have to undergo a training by RVO for 50 hours, then sit for the exams, qualify for the exams, get myself registered with IBBI. So I'll be granted certificate of registration. I'll become a member of RVO. Certificate of registration will be granted by IBBI. I'll become a member of RVO. Certificate of registration will be granted by IBBI. And then when doing a valuation, I have to comply with the valuation standard. Eligibility criteria. Eligibility criteria. Now, what is the eligibility criteria for an individual? For an individual. Now, remember, as a valuer, there can be two people who register themselves as a valuer. One, as an individual, myself, Naveen Khandelwal, can become a registered valuer. As I said, I have to enroll myself with an RVO. I'll get a certificate registration from IBBI, provided I pass the examination. Or I individually will be a member, but I will be part of a company or a partnership firm. And they will apply for registration. So there could be a company where the directors are registered valuer. So the company will be known as Registered Valuer Entity, RVE, Registered Valuer Entity. So today, I individually can become registered valuer, and RV can also register themselves as a valuer, but RV will consist of company. RV will be a company or a partnership firm where the directors, or the partnership firm where the partners are registered valuers. So an individual shall be eligible to be registered valuer if he is a member of RVO, first condition. He is recommended by RBO for registration as a valuer. So I will be registered with IBBI. I will be a member of RBO. Then he should have passed the examination within 3 years preceding the date of making an application. So if I make an application for becoming a member and registration, I should have cleared my valuation exams in the past 3 years. And I possess the required qualification and experience. Obviously, I should not be a minor, should not have been declared of unsound mind, and not an undischarged bankrupt, or not applied to be adjudicated as a bankrupt. Resident in India, not convicted of any offense for a period of not exceeding 6 months, or for offense involving moral turpitude, and 5 years has not elapsed from the date of expiry of sentence. And provided if a person has been convicted for any offense, sentenced for a 7 year or more, he shall not be eligible. And he should not have been levied a penalty under section 271J, because 271J is a newly introduced section about 2-3 years back, where a penalty is imposed on the professional also. And is a fit and proper person. This is an exam question, friend. All these points, who is eligible for a registered valuer? So remember that. Now, a company can also be a registered valuer. When can a company be a registered valuer? No partnership or company shall be eligible. So it starts with a negative word. If it has been set up for objective other than professional, financial, or valuation services. So the objective should be this. If it is undergoing an insolvency resolution process. All partners, directors are ineligible under clause C, D, E, F, G, H of rule 1. That is, individually they are not qualified. 3, all partners, all directors, whichever is lower, are not registered valuer. When they themselves are not registered valuer, how can an RV also become registered valuer? None of its partners is a registered valuer for the asset class. Very simple. So these are the conditions on the negative way. So if it has been set up for the objective of this, if it is not going in insolvency resolution places, where directors are eligible, where the partners and directors are registered valuers, and partners and director is registered for valuer for the asset class. As I said, there are 3 asset class, so there should be directors of, should be 3 directors who should be categorized as valuer for 1, 2, and 3 registered asset classes. So there should be 1 director who should be a registered valuer of plant and machinery, 1 director of land and building, 1 director of SFA asset. I hope it is clear. Qualification which is required. Qualification which is required. This is important. As a chartered accountant, we should be aware that what is the qualification. If you want to become a registered valuer, then what qualification should I have? So the qualification is that first, I should be having a postgraduate or diploma and minimum 3 years of experience in the specified discipline. First criteria. That means MBA can become a registered valuer. The answer is yes. MBA can become a registered valuer. Second, if you have a bachelor's degree, then minimum 5 years of experience. Bachelor's degree or equivalent in specified discipline, then 5 years of experience. So that means even a bachelor degree can make you qualify for a registered valuer. And if you are a member of professional institute like ICI, then minimum 3 years of experience. All those specified discipline and education is given in explanation. For example, plant and machinery, you should be qualified as an engineer. For land and building, graduate or a postgraduate, as it is mentioned, bachelor's degree and minimum 5 years of experience. And for SFA, if you are postgraduate in finance, 3 years, member of ICI, 3 years. That means, as a chartered accountant, I cannot enroll myself as a land and building valuer or a plant and machinery valuer, and vice versa, or vice versa. Now, the other criteria is that they should, all registered valuer have to pass an exam conducted by NISM. That means once you have a 3-year experience, you have to enroll yourself for the exam and attend the training, appear in the exams, and clear the exams. Last line is important. Individual may appear for the valuation exam in number of times. Though it is held once in 3 months, that means every quarter you can appear once only, in a year 4 times. So it is held in the NISM centers and the minimum passing marks is 60%. Objective type question paper with negative marking. Any answer to this question? Who is eligible to become a registered valuer? If you have logged in, you can answer it. So, so the correct answer is D, easy one. Who cannot be eligible to be registered value. Sometimes if a MCQ comes and where they have asked in a negative way, I think the best way is to delete that negative word. And who can be eligible to be registered valuer? Declared of unsound mind? No. Convicted of offense? No. Undischarged bankrupt? No. So these are the people who cannot be a registered valuer. Who cannot be registered valuer. All of the above, the correct answer is all of the above. Now, when you apply for registration, what are the conditions of registration? Obviously, you should possess the qualification. That's fine. You should comply with the provisions of the Act. That's also fine. You should not conduct valuation of that class of which you are not being registered. That's fine. Maintain records for each assignment undertaken by him for at least 3 years from the completion of such assignment. Comply with the code of conduct of the registered valuer for which is members. So that is a very important aspect, that he has to maintain record for at least 3 years. But at least, you may maintain it for 4 or 5, but at least 3 years is required. Then nothing more important from exam point of view. I think that's all. If you consider relevant for exams, yes, this is important. This is important. So valuation which has to be done, it has to be conducted in compliance with the valuation standard under Rule 18. So there are two valuation standards, the International Valuation Standard and ICI Valuation Standard. So each RVO has adopted each valuation standard. So if you are a member of ICAI RVO, then you will have to comply with ICAI valuation standard. If you are a member of ICSI RVO, there are about more than 16 RVOs, 16 to 18 RVOs across India who are enrolling registered valuer as a member. So it depends upon of which institute or which RVO you become a member. And that RVO has given an instruction of that you have to follow this particular valuation standard. So in India, there is only ICI valuation standard, or internationally, you can follow the IVS valuation standard. These are the two valuation standards which you have to follow. That is the first thing, that is the conduct of valuation has to be valuation standard. Second, if you rely on a valuation report done by any registered valuer in your report, then you have to take into cognizance, you have to mention the name of the other registered valuer and mention that you have to relied on the report of that other registered valuer. Now, what is the content of that valuation report? What should be there in that valuation report? So what are the contents of the valuation report? So the contents are: first, the background information of the asset, purpose of valuation and appointing authority, identity of the valuer and other experts involved in the valuation, disclosure of valuer interest or conflict. So these are certain standard things. Background information of the asset, that means the shares. Let's say if you are valuing shares, the company name, details, what asset class you are valuing, what are the types of shares, equity shares, preference shares, convertible shares, whatever. Then your identity, your name, details, any other expert who you have involved in the whole process of valuation, date of appointment, valuation date, and date of report. Any inspection, investigation undertaken by you, normally you review the documents. So let's say MCA data or any other information which you have gathered, done any inspection. So give a detail about that inspection. All the documents on which you have relied upon and information, balance sheet, provisional statement, future projections, bank statement, and any other document, market data, market information, business profile, memorandum, legal agreements, whatever you could rely upon. So these are the details of the information which you have to mention. Then procedure which you have adopted in valuing the standards. Let's say you have to mention the valuation standard which you have to follow, which standard have you followed, why not the other standard, the reason for the same, and giving a detailed explanation of how you have carried out that valuation based on that valuation standard, plus the caveats and the limitations and the assumptions for carrying out the valuation report. And at last, the conclusion part. You can mention the conclusion. The fair value of share is this much rupees. And that is a one-line conclusion which you can draw from all these assumptions. So it's not only a certificate, it's a report, remember. And report will consist of number of pages. So therefore, the assignment is not only a small one-day assignment. It spreads upon, depending upon the type of valuation and the complexity involved. And it may spread upon from 3 to 4 days to 10 to 15 days also. In some cases, extend more, depending upon, as I said, the documents, the complexity of the transaction, and so on. So these are the contents of valuation report. This is a brief only outlay. We have not gone into the internal details. I've just given a hint that what could be the basic contents of the whole valuation report. Let us take one example. The Bola director of Bhandari Limited entered into an arrangement with his friend and acquired asset in the name of Bhandari Limited by passing a resolution. The notice for resolution included particulars of arrangement along with the value of asset duly calculated by a registered valuer. Later, the board discovered the loss arising out of incorrect statement in the report made by the valuer. In this case, valuer is convicted of incorrect statement, giving the report made with the intent to defraud the company or its members. So the answer is yes. If there's an intent to defraud the companies, then there is a punishment and you'll be liable for that particular punishment. So that is all about registered valuer, friends. Any questions on the registered valuer rules? Anybody who has any point regarding registered valuation? It's a very brief, but then once you decide to pursue this course, you'll find out altogether different world. So what are the questions which are expected? One is direct 247. Then the eligibility criteria of becoming a registered valuer. Eligibility criteria of becoming a registered valuer. Penal provision case scenario. That is 247, 3 and 4. And the contents of the valuation report. And namely, you should be aware of the valuation standard also, so that you have a brief idea that you have to comply with the valuation standard. And if you are not complying, then there may be certain issues coming up with the valuation standard being not being complied with. Right? Okay, so let us move ahead and understand the whole world of removal of names of companies from the register of companies. So friends, what we have seen is insolvency, winding. There are two provisions: insolvency, winding up. We have done winding up, which will ultimately lead to dissolution of the company. Insolvency will either lead to change of management, or ultimately, if no dissolution, then liquidation and then dissolution of the company. Now, under Companies Act, there are certain provisions regarding strike-off and dormant companies. Strike-off and dormant companies. Now, strike-off and dormant companies have got certain conditions attached to it. the differentiation between these two, and practically there are many cases coming under striking off. Let me tell you fact. If you refer to NCLT and daily hearing at NCLT, there are applications which are filed for restoration of company from strike off. In the last 5 to 6 years, government has taken a lot of initiatives in cleaning up the whole system of the company's corporate world. And in the last 5-6 years, what they have done, voluntary, they have struck off many companies by virtue of this section, so that people are aware that if you are dealing with such companies, they are already striked off. And striked off means there is some problem with the company. That is why this provision has been introduced, and government has taken sumoto certain exercises, steps. So therefore, it is a very relevant from exam perspective and practical also. First, let us understand the difference between winding up and strike off. Winding up basically refers to complete closure, and restoration is very less likely, except in 356, there is a time period of 15 years or something like that. If there is some transaction amount left to be distributed, then in that case, there could be a possibility, but very less likely. And strike off, his restoration is possible anytime till 20 years. Today I was at court, and there was one company which had applied for restoration of strike off companies where there was no filing done in the last 20 years. It's a practical hearing which I attended today. I was not part of that hearing, but I was there at the court, and I could see other people making a presentation in front of the honorable members of the tribunal. So winding up, complete closure, strike off, there is a possibility of restoration. Now, what are the modes of strike off? What are the ways, techniques of striking off the company? First is the strike off can be done by the registrar. And second is company voluntarily goes and strikes off. Now we all understand, yes, registrar striking off is very natural. But why would company go and tell, please strike me off? Obviously, there should be certain reasons. First, let us understand how registrar can do the strike off, what power he has got, and what are the trigger events which will tell that the company could be striked off. Power of registrar. Power of registrar. Where the registrar has reasonable cause to believe that a company has failed to commence its business within 1 year of its incorporation. Very important. It has been seen in many cases, people form a company under the fancy of becoming a director of a company. And they do so. Great, it happens. But once they become a member and they become a director, and then they forget that they have to start the operations, they have to run the business, and they have to comply with certain filings at ROC. So when you are not able to do that, the registrar can strike off your company. Or when a company is not carrying on any business or operation for a period of 2 immediately preceding financial year, has not made any application within such period for obtaining the status of a dormant company. So that means you are not doing any business for 2 immediately preceding financial year. Now business means there are no transactions. All the balances in the balance sheet remain same from asset and liability. No change in that. Absolutely zero change. That will mean that you are not carrying on any business, except that you have paid money for filing of documents at ROC. Apart from that, nothing has been done. There are no assets lying, and probably even if there are assets, but the ROC thinks that nothing is being done, so let's strike it off. When subscriber to the memorandum have not paid the subscription which they have undertaken to pay at the time of incorporation, and the declaration to this effect has not been filed within 180 days of its incorporation. Very important under section 10A. This has been a very common mistake which people have committed, and probably because of ignorance of law at times. You form the company and then later on we start the business, you are carrying on, but somehow there has been a gap in communication between the consultant and the owner, and even the consultant forgets because he has received his money, the company is doing its business fine, because the law says that under section 10A you have to file a declaration that yes, the subscription amount, whatever has been mentioned in memorandum of officiation, that these are the subscriber to the memorandum and they have paid that money. That declaration has to be filed with ROC, and because you have not filed it, therefore the company can be wound up. Striked off. And there could be a possibility the registrar comes to your office, and when he visits the office, he finds that there is no business being carried on or operations being carried on after the physical verification, and he feels that yes, the company is not doing anything, let's strike it off. As currently it is happening in the world of GST. If you are aware what is happening in the world of GST, there are physical verifications being conducted by the GST department. And once they do a physical verification and come to know that the business is not being carried on, they may cancel the certificate of registration under GST. So 5 conditions, 4-mark question. 5 conditions, 4-mark question, direct question. When can registrar strike off the company? When can registrar strike off the company? Right? What he will do? What he will do, that means suddenly he will strike off the company? No. He will send a notice, STK1, obviously understood, strike 1, and all to the directors of the company of his intention to remove the name from the company, from the register of companies, and requesting them to send their representation along with copies of relevant document, if any, within a period of 30 days from the date of notice. That means an opportunity is given to the company and to the directors that please let us know if you have done anything, you have filed, and whatever reasons which you have, just let us know. And we give you 30 days, which is sufficient enough. Very important. This is an exam question, more important exam question. More important than when the registrar can remove the name. Here it is said that if the company falls under this category, he cannot remove the name. The first condition is, if it's a listed company, very natural, public is involved. Second, companies that have been delisted due to non-compliance of listing regulation or listing agreement. So there's a listed company, they have got a listing agreement with the stock exchange and SEBI, and when they are not complying with the listing rules of SEBI or the listing agreement between them and the National Stock Exchange or Bamboo Stock Exchange, and by virtue of non-compliance of those listing regulation, the SEBI and NSE has delisted that company. So that means you will say that this is not a listed company, let me strike it off. No, it's a listed company but has been delisted because of non-compliance of law. Then they are not allowed to strike it off. Third, vanishing companies. Very important. Please note it down. What are vanishing companies? New term, and they have been asked in the exams. Vanishing companies. We'll discuss that. Companies where inspection or investigation is ordered and being carried out and on such orders are yet to be taken or were completed, but prosecution arising of such inspection or investigation are pending in the court. 210, 212. So when the inspection and investigation is being carried out under those sections and they are pending, or a prosecution is pending at a court, then also. Companies where notices under section 234 of the Companies Act, old section, or 206 or 207 have been issued by the registrar or inspector, and the reply thereto is pending, or report under section 208 has not been submitted. So remember 206, inquiry, inspection, investigation. So first is inquiry. So let us say in the 206 or 207, the inspection is going on and the report has been prepared or not been submitted, then you cannot. So that means investigation, inquiry, anything is pending, strike off is not possible. Or there is a court case pending at any court for which any prosecution for an offense is pending. Then if you have applied for compounding before the competent authority for compounding offenses, now what does compounding offenses mean? We'll discuss it in our next class, maybe in next month, where we'll discuss about compounding, where things are clubbed together and you apply that I have committed multiple offenses, let us club together. Companies which have accepted public deposit, again public is involved, which are outstanding, or the company is in default in the payment of the same. Company has a charge, that means it has taken a loan, that means bankers are involved. If bankers are involved, again public money is involved. So indirectly public money is involved. And if it's a section 25 company or section 8 in the current law, that means not for profit organization, NPO. So if it's NPO, charge creation, this will all are conditions which will prevent the registrar from striking of the company. What are vanishing companies? Vanishing companies are companies which are formed and suddenly the next day they vanish. Anyway, so they are companies which are listed with stock exchange, but they have failed to comply with the return filing of ROC in stock exchange for a period of more than 2 years, not maintaining a registered office, and they are just notified with the registrar companies or stock exchange, and none of the directors are traceable. That means it is like one of the shell companies. It is like one of the shell companies which have been created for some wrong purpose, and today they are not traceable. Things are not right with these companies. So in there have been a lot of companies which are in vanishing nature. Today, the compliance is very strict, and the stock exchange and every agency is on the vigil. Whenever they find any hint of these kind of companies, they take action immediately. But 10 to 15 years back, probably there were many instances where there was no track of companies, no proper vigilance mechanism, no real-time compliance measurement. So probably in those times, these companies existed. Current scenario, I believe it is very difficult to find such kind of companies, vanishing companies. So one is application by the registrar. This application by the registrar will take a suo motu action. The second is application by the company, where the company will go and tell, let's strike it off. So company may, by after extinguishing all its liability, very important. after extinguishing all its liability. That's the important criteria reference. Now that is a tough job. You have to extinguish all your liabilities. All liabilities means it's not only about paying the creditors, but all tax liabilities also. And which is very difficult at times to continuously keep a track of all the income tax, because all income tax notices are received after some time period. You file a return and the next day you receive a notice. It is not possible. In one of the cases, what I've seen, where I had done a voluntary liquidation, I had taken an NOC from the income tax department. They have given an NOC, but then even after filing an application of dissolution, I received as a liquidator, the company received an demand notice after 1 year of filing the dissolution. Now that becomes a challenge. So company, after extinguishing all its liability by a SR or a consent of 75% of members in terms of rate of share capital, file an application in the prescribed manner to the registrar for removing the company from the register of companies. And once the registrar receives such application, a public notice in a prescribed manner will be given. See, there's a process which is defined. Striking out does not mean that it's you just go and apply and your company name will be striked off. No. People should be aware. People should come to know of this knowledge that this company is getting striked off. Don't deal with such companies. That is why a public notice is issued in the prescribed manner. And if that company falls under any specific regulatory body, insurance company, banking company, or so on, it has to take an approval of the same. Obviously, very natural. Obviously, these are provisions not applied to Section 8 company. Publication will be done in official gazette, that's fine. Now, what is going to happen? At the expiry of the time mentioned in the notice, the registrar may, unless cause to the contrary shown by the company, strike off its name from the register of companies and shall publish notice thereof in the official gazette. That means, again, it will come in the paper, in the official gazette, that these are the companies which have been struck off. And the company shall stand dissolved. The company can stand dissolved. Very important. This is a last stage of dissolution of the company. Obviously, with a chance of restoration, remember. So that means today, as a company, as a director, as a founder, as a promoter, I should know how to close my company. First is I can get it strike off, but there's a possibility of restoration. Remember, anybody can restore it. And second is voluntary liquidation, which will finally close down a company. There's no such option of restoration in that case. So, after the expiry of time limit mentioned in the notice, and strike off the name and then publish it in the official gazette that this company is being striked off. These are steps which are to be taken by the registrar under an application made by the company itself. And obviously, when the registrar is also taking that step, the official gazette has to be there. You have to publish the name. The registrar, before passing an order, shall satisfy himself that the sufficient provision has been made for the relation of all amount due to the company and for payment or discharge of liability and obligation by the company within a reasonable time, and if necessary, obtain necessary undertakings from the managing director or person in charge of the company. That means there may be a requirement of keeping a bank account. When the company has made an application, they'll say that, registrar will say that, please maintain a bank account. And though I'm striking off the company today, but please ensure that bank account is maintained, and whatever amount which is received and whatever the claim I've received after this date should be paid off, and provide this an undertaking for the same. Maybe an income tax refund order. Income tax refund order which may be received after 2 years, 3 years. Then how do I receive that amount and how do I distribute that amount? That's important. Provided that notwithstanding the undertakings referred to in section this, the assets of the company shall be made available for repayment or discharge of all its liability and obligations even after the date of removing the name of the company from the ROC. That means the assets should be available even if the company has been striked off. If you receive any money and there's an obligation, so payment should be made to fulfill those obligations also. So there are, backup provisions which are created in the case of any event happening subsequent to striking off, which will normally not happen in case of liquidation, voluntary liquidation under IBC. But here the provisions are there. So 248, very important section. And the director, the promoter, founder may feel happy that the company has got striked off. I am relieved of all my liability as a director. The answer is no. The answer is no. Very important. The liability of, if any of every director, manager, officer who was exercising any power of management and every member of the company dissolved shall continue and may be enforced as if the company had not been dissolved. So if there's a liability coming on to the company later on after the company has been striked off, the manager cannot escape, director cannot escape. They are responsible for all the future liabilities also. Now question comes in. Can tribunal order winding up of company which has been striked off? Nothing in this section shall affect the power of tribunal to wind up a company, the name which has been striked off from the Registrar of Companies. Yes, the answer is yes. The company has been striked off. Let's wind it up also. Full and finally, everything gets over. So an exam question may come in the form of an indirect question that what will happen to the liabilities once the company has been striked off. So you need to keep these provisions in mind and tell the liability will remain there. Once first answer, the registrar should ensure that he has made proper arrangements of discharge of all the liabilities even after the date of removing the name of the company from the Registrar of Companies, and has also made arrangements for relation of the amount, plus the liability of directors will remain there. Okay, so let's answer this question. The Registrar of Companies was reviewing the financial statement of White Steam Private Limited, which was incorporated 8 months ago. Or if you find that subscriber to the MOA of the company had not paid the subscription money or not, they filed a declaration of the effect, RC striked off the name of the company from the Registrar of Companies upon legal compliance. Fine. The law says that yes, if you have not filed a memorandum of declaration about subscribing to the memorandum, which is required under rule section 10A, the registrar may strike it off. But yes, before striking off, and notice should be sent to the company and their directors that I'm taking this step. Do you have anything to reply upon the same? So the answer is yes, 248(1)(b), where the registrar has reasonable cause to believe that they have not they filed a declaration for undertaking paying the subscription amount. He shall send a notice to the company and directors of his intention to remove the name. And within 30 days, the people have to reply. So if there is no such reply, then the registrar has the right to remove the name of the company. Then they have got the mandate. ABC Insurance Company was incorporated following all the legal procedure, but the company cannot commence its business operation for a period of 1 year since its incorporation. Good. The members decided to get its name removed from the ROC. Bad. Consent of 80% in terms of paid up share capital was taken for the removal of the name. Okay. Application was filed. Fine. Validity of the application. Let us see. See, the question is fine. No business. Great. You become eligible. 80%, you become eligible. So you think that they should be eligible. But this being an insurance company, and we have understood the, see, the kind of question which will come in exams of this nature, very peculiar, very typical. You will be surprised at times. The question will be very simple, but only with a catch. Only with a catch. So being the insurance company, therefore we have read the provision that if a company falls under the category of any regulatory authority, and if that law asks for any specific permission, then we should have a specific permission from the respective regulatory authority before an application could be made. So approval is required for IRD. Now there are restrictions of filing an application under Section 248. So when the company wants to apply on its own, then it cannot do so if any time in the previous 3 months, the company has changed its name or shifted the registered office from one state to another, has made a disposable for the value of property or rights held by it immediately before the seizure of trade or otherwise carrying on the business for the purpose of disposal for gain in the normal course of trading or otherwise carrying on of business. That means in the last 3 months, it has made a disposal of the value of property, disposed of any property or any other matter, any other rights held on that property before they are winding up the business for the purpose of disposal or for gain, for the purpose of any gain. So maybe they are not winding up the business, but yes, generally they have sold it. So in that case, you may not be allowed. To apply. Has engaged in any activity except the one which is necessary or expedient for the purpose of making an application under this section or deciding whether to do so or concluding the affairs of the company or complying with any statutory requirement. So you are engaging in any activity other than normally which is necessary, for making an application or concluding the affairs of the company. For that purpose, you are taking any activity, that is fine. But apart from that, if you are taking any other activity which gives an indication that you don't have intention to close down a business, but you want to run, and probably you want to strike it off for some other purpose. So there is some purchase sale of asset, there is some inventory lying, purchase sale of inventory. So if these are certain indications which highlight that the business is being carried on, then your application may be rejected. If an application for compromise or arrangement has been pending at the court and you have applied for winding up or voluntary liquidation, both the scenario. Under both the scenario, it is not allowed. So again, this is an exam question, friends. You have to remember under what conditions it imposes a restriction on making an application. Penalty, if you violate the relevant provisions, then there's a penalty. What is that penalty? Punishable with fine which may extend to 1 lakh rupees. Violation of any of the above conditions for filing, so there should be a penalty. So that is fine. I mean, that's a very normal penalty. So we don't expect if a company is being striked off by the company itself, then there should be certain purpose. And if you're not having a reasonable purpose, then the company may not be striked off, or you are making a false information. Okay, so company is a private limited company incorporated in the year 2013. The company deals in manufacturing of glasses. Since May 2018, the company is not carrying any business. In April 2020, the company shifted its registered office from office Jaipur to Ahmedabad. 2nd May, the company decided to file an application for strike-off. According to Section 49, the sale of the company will not be valid because the application can be filed only after 3 months from the date of company shifted its registered office. Right? So these are certain type of questions which can be formed based on small provisions of the Act. Yes. So be careful when you are reading, when we are discussing, catch those points, note it down in your copy or any notebook which you are maintaining. And these are small points which makes a difference between, the pass and fail. So once the company stands dissolved under Section 248, then it ceases to operate as a company. The certificate of incorporation issued to should be deemed to have been cancelled from such date. So the question exam is, what is the effect of company getting striked off finally as dissolved? So these are the effect. But for realization of certain amount, the company shall continue to remain in existence. So let's say if there's a refund order which is pending for long and there may be certain technical issues, then to that extent, the company will be in existence. But practically what I've seen that if these kind of transactions are pending, the company's name will never be striked off. Until everything is closed, the company may not be striked off. Now, when this application is made with an object of evading the liabilities of the company or with the intention to deceive the creditors or to defraud any person, the person in charge of management shall, notwithstanding that the company has been notified as dissolved. So you have made an application, but the intention is malified. But that because of the application and the documents which you have submitted are clean, and therefore the company got dissolved. But later it was found that the intention was something else. They will be held jointly and severally liable. Fraud under 447, which we are going to discuss. And the registrar has got powers to recommend, not prosecute. They can recommend prosecution of the person responsible for filing of an application under subsection 2. That is the application by the company itself. So, recently, which we have seen that there are a lot of action taken against fintech companies. If you read newspaper, these companies were backed by some Chinese people, or there were a lot of apps which were running on Play Store, and these apps were owned by certain companies which were found to be suspicious in nature. Now, though the actions have been taken by the agency and suddenly an application comes to the register office that they want to close down a company, and the registrar is, let's say, not aware because our system is not yet strong and robust that things are got interlinked. So case may be pending at somewhere else and their application has been filed and nobody is aware of the fact. But then the intention is obviously to defraud the creditors or defraud other people. So in this scenario, these particular sections are invoked. So very rarely, but possibility is there. Any questions? Though, because I have not been receiving any questions, just wanted to confirm. If you have any doubts regarding the same, you can please raise your point. Because no questions and no communication till now. This is again very important section of restoration, very important. So one is 248, 249. 248 is all about who can apply. 249 is restriction. 250, 251 are normal, penal provisions and so on, but not that much relevant. But 252 is definitely relevant. 252 is definitely relevant. Now, why this is relevant? Because it talks about restoration. And when you observe the NCLT cases, you will find a lot of applications being made for restoration. Because that suo motu exercise was done by Registrar. They have striked off the company. And today, the directors they come to realize that my company has been striked off and I have a land in that company. Or I had got a license in that company, which is now becoming very important because of changes in law, nature, climate changes, and whatever things have become very dynamic, we all understand. So maybe because of that reason, they find an opportunity now to run the business of the company. So when a person is agreed by the order of registrar notifying company as dissolved under section 248, may file an appeal to tribunal within a period of 3 years. 3 years time period has been given. And if the tribunal is of the opinion, NCLT is of the opinion that the removal of the name of the company from register of company is not justified in view of the absence of one of the grounds on which the order was passed by the registrar, it may order restoration of the company in the register of companies. So if the tribunal finds that yes, it was not justified, let's restore it. Many times the department comes and file an application. Department will come and say, I have a certain demand with that company. You have striked it off. No, please don't do it. Just restore it so that I can put a claim of department in the name of the company. So a lot of cases have been filed by the promoter. A lot of cases have been filed by the income tax department and so on. So an application is filed, a notice is given to all the department and the ROC that this company has been striked off, but then restoration has been filed. Do you have any objection on the same? So maybe notice may be given to the income tax department and ROC for the same. One is appeal against the order. Second is suo motu by the registrar, restoration of by the registrar. If the registrar is satisfied that the name of the company has been struck off from the register of companies either inadvertently or on the basis of incorrect information furnished by the company to or its director, then he also may apply within 3 years from the date of passing of order dissolving the company and seeking restoration of the name of such company. So even the ROC can come and say, I did a mistake because probably I did not have proper information or whatever information which I had asked from the directors because I had sent a notice to them and within 30 days I had sent a notice and they had replied, and on the basis of their reply I had striked it off, but then today I come to know that something is not correct. Therefore, let me apply and restore the company. So once the tribunal passes an order, it has to be filed within registrar from the 30 days, and then he will restore the company and issue a fresh certificate of incorporation. Fresh certificate of incorporation. Last but not the least, order of tribunal as it may deem just and fair. The tribunal on an application made by the company, member, creditor, or workman before the expiry of 20 years from the publication in the official gazette of section 248 is satisfied that the company was at the time of its name being struck off carrying on business or in operation, otherwise it was just that the name of the company may be restored to the register of companies, then tribunal may order as it may deem just and fair. So under 252(3), there is a provision that it can be restored before the expiry of 20 years. So striking off gives the possibility of restoration. Winding up does not give the possibility. Voluntary liquidation does not give the possibility. Winding up is apart different condition. Voluntary liquidation can be done again in a different condition. And striking off has got different reasons that why the company should be striked off. So friends, very important, relevant law, 248, 249, 252. 248, 249, 252. Possibility of being asked in the exams is high. So don't miss out on all these three provisions, which can give you 4 marks. Right? Small, very in brief, let us cover this government companies and annual reports on government companies. So we have covered 2 aspects, friends. One was valuation and other is striking off. Let us go through this of government companies. Now, as per section 245 of the Companies Act, government company means a company which is not any company in which not less than 51% of the paid up share capital, both equity and preference. Now, that's an exam question, friends, where the confusion will be coming 51% of what? So, both equity and preference is held by this, because they will give you a practical case scenario, giving you figures, equity share capital, preference share capital, debentures, reserve and surplus, and then you get then the confusion starts. So very clear, 51% of the paid up. So there might be an issue, subscribed, and so many things is held by the central government or by any state government or governments, or partly by the central government and partly by one or more state government, and includes a company which is a subsidiary company of such government company. So you can understand to the extent of to what extent I have to go to understand to classify this company as a government company or not. And the paid up share capital shall be constituted as total voting power where shares with differential voting rights have been issued. Again, we have to consider total voting power. So where the central government is a member of a government company, then the central government shall cause an annual report on the working and affairs of the company to be prepared within 3 months of its AGM, before which the comments given by the Controller and Auditor General of India and audit report are placed under the provisions of section 143. So annual report has to be prepared after the AGM is conducted. And once it is prepared, it has to be laid down before both the houses of parliament, together with the copy of audit report and the comments thereon, made by the Controller Auditor General of India. So, simple exam question, what are the compliances to be done in case a central government is a member of the government company? So, these are the compliances which you have to mention. And if there is a state government which is a member of that company, then and only one state government is a member, then state government shall cause an annual report, be prepared within the time specified in the section 394, that is 3 months, and they have to be placed before the houses of the state legislature. So these are the compliances part of the government company. So please ensure that a small section, first by the definition, which is a government company. For that, you can have a practical question. So please note down the important points. What does paid up share capital means? What does 51% of what means? And for that, you should have practical knowledge of what are the types of instrument, whether convertible preference shares, convertible debentures, what are they classified? How are they classified? So accounting, Ind AS knowledge is very much required when you want to understand the balance sheet items. Accounting and Ind AS, anything which is based on balance sheet is driven by Ind AS and accounting items. So do ensure that you have sufficient knowledge of the same. So under miscellaneous said, we have covered 3 topics till now: government, strike-off of companies, and valuation. Valuation, as I said, is a very important angle. We'll come back later on also and cover revise one or two important aspects of valuation. So we here take a short break, and after the break, we'll restart. अशोक जी एक बार चेक कर लेंगे, कोई क्वेरी नहीं है ना अशोक जी? हाँ जी, क्या बोल रहे हैं? अच्छा अच्छा, ठीक है। हाँ ठीक है, ओके, वही मैं बता रहा था कि क्वेरी नहीं है इसलिए। ओके, so let us start with the section of first let us me take the section for dormant company, friends, and then we'll come back to the world of frauds, and then maybe in short we'll cover the Nidhi companies also. So dormant company. Now the difference between strike off and dormant, that's important. That's what we need to understand. Where a company is formed and registered under this act for a future project, or to hold an asset or intellectual property and has no significant accounting transaction. Very important. Future project, hold an asset or intellectual property and no significant accounting transaction. Such a company or an inactive company may make an application to the registrar in such manner as may be prescribed for obtaining the status of a dormant company. So for example, let's say today company has purchased a land, but then the idea is to start the business or take a project after 3 years, 5 years. Maybe they are getting some opportunity to get a land, but their idea is that they will come out with a project after 5 years. Let's say Tesla wants to have some project in India. Maybe they have a planning after 5 years. They want to explore this Indian market, understand, and therefore they just buy a land. They create a company, and they're just holding that intellectual property which they have been created to something create in India, but maybe not now. So, and they are doing not any business transaction. They're just carrying on any simple debit and credit transaction of very routine nature. Then under that scenario, an application can be made by the company to make it a dormant company. Now the question comes in, what is significant accounting transaction? What is significant accounting transaction? So means any transaction other than payment of fees by the company to registrar, payment made by it to fulfill the requirement of this law or any of this act or any other law, allotment of shares to fulfill the requirement of this act. So, and payment for maintenance of its office and record. Small accounting software has been taken, or some payment is made to an accountant, office rent, small office rent, and compliance of law. So to that extent, if you are doing any transaction, then it's fine. Apart from these transactions, so something is very clear, any tax payment, very clear allotment of shares. So let's say whatever you have to make payment for section 62, that will be allowed. Maintenance of its office and records, a bit of ambiguity because that may cover a lot of expenses at times. But anyway, we can understand there cannot be any sales and marketing head. There cannot be any payment to a lot of staff. There cannot be any payment for production, purchase, and so on. So they have to make an application in Form 1 and Form MSC 1. And after passing a SR to this effect in the general meeting of the company, or after issuing a notice to all the shareholders of the company for this purpose and obtaining a consent of at least 3/4 shareholders in bed. Very important. So either SR or take a consent from the members, shareholders, for at least 3/4 shareholder in value. So once you do that, I think things become very easy. So this is the precondition for filing an application for bringing on the status of dormant company. Non-eligibility, again an exam question, remember, this could be an exam question. A company shall be eligible to apply under this rule only if no inspection, same as, strike off, no inspection, inquiry, investigation has been ordered. No prosecution has been initiated and pending against the company. Company is neither having public deposit which are outstanding, nor the company is in default in payment of thereof interest. And the company is not having an outstanding loan, whether secured or unsecured. Therefore, it was more of secured. No charge has been created. Here, there is no mention of charge, but it is written a secured or even unsecured loan. So this is the difference, friends. Remember, this could be one of the difference between exam question of non-eligibility of companies for applying for dormant status or striking off. Though in striking off there are more, here there are also more. However, if there is any outstanding unsecured loan, the company may apply under this rule after obtaining concurrence of the lender. So there is a gap given. There is an escape route available. Very important. There is no dispute in the management or ownership of the company, and a certificate in this regard is enclosed. So we need to take a declaration from all the management directors that we are bye. There's no such confusion between us, and we are applying in total consciousness for this particular dormancy status of the company. Then the company does not have any outstanding statutory dues, anything which is payable to central government or state government or local authorities. So once the company applies, then it may file, that may get us dormant status, or action may be taken by the registrar. So again, same step, same as in the case of striking of the companies, where the company has not filed financial statement for annual return for 2 financial years consecutively. Notice may be issued, and the name of such company may be entered in the register of a dormant company. So same provision that registrar today, very important. What are the powers of registrar with respect to striking off or dormant company? Not carrying on in business or operation for 2 immediately financial years, preceding financial year. So there is no business being carried on or operation. Right? Business being carried on or operation for 2 immediately preceding financial years. While here, the law says not filed any financial statement or annual return for 2 financial year consecutively. So in the last 5 years, if there's no business operation and no annual return has been filed, then the registrar can either strike it off or classify this company as a dormant company. So that's a choice. This choice given to the registrar. But it is running a business and has not filed financial statement. Now, how will they come to know? Maybe by inspection, by third-party information, by visit. The business is being carried on. While GST returns, there may be a possibility that you may have access to GST returns. They are showing purchase sale transaction, but annual returns are not being filed for any reason. So in that case, dormant status, no strike off. Filing annual returns, dormancy cannot be a choice. So the registrar shall issue notice to the company, and then accordingly, the registrar can take steps. So in case of directorship of a dormant company, they shall have minimum such number of directors, file such documents, and pay such annual fees to the registrar to retain its dormant status, and may become an active company on an application made in its behalf, accompanied by such document and fees. So from dormant status, they can become active also. From active to dormant, dormant to active. Minimum number of directors is 3 to 1, same 3 in public, 2 in private, and 1 is one-person company. Provision of rotation of auditors shall not apply on dormant company. That's an exception given. So maybe a question would come with respect to rotation of auditors, and they may mention that the company is a dormant company. So please do remember. So that's a catch out here. Rotation of auditors will not apply to dormant companies. What about all the annual returns? So dormant company shall file a return of dormant company within a period of 30 days from each of the end of the year. And they will also file return of allotment, change in directors, whatever is required under the law, they have to file. Application for seeking the status of active company. So once you feel that there are significant accounting transactions which has to be taken place, now we have to start the business and we have filed the returns and everything. So they may make an application for obtaining the status of active company. Then after considering the application, may give the status of active company. Or where a dormant company does not omits to do any act mentioned in the grounds of application, submit to the registrar for obtaining the status of dormant company. So when you are applying for a dormant company status and then you are entering into any transaction or omits to do any company or does something which is prohibited, you do something which is prohibited. We have seen that under these scenarios, they will not be allowed. So if those events happen, then whenever you file a status of dormant company, then within 7 days after such event, you have to file an application for obtaining the status of an active company. Even the registrar can do it. It's not only about by the company. The registrar, when finds he has a reasonable cause to believe that any company registered as a dormant company under his jurisdiction has been functioning in any manner, he may initiate the proceedings for inquiry under section 206, and if after giving a reasonable opportunity of being heard, it is found that the company has been actually functioning, then he may remove the name of the company from dormant and treat it as an active company. So because you're treating it as an active company, you have to comply with all the normal regulation. So you will not get these benefits of being a dormant company. So when you have, so active status can be first by the registrar on an event which actually is prohibited in the act from making an application from active to dormant. And if that event takes place, so director on its suo motu. And normally when the directors may apply that, I want to get the status of active company. So one is in normal circumstances. Second, dormant company does or omits to do any act which is prohibited under this section. Then, and the registrar may on its own after conducting has a reason to believe that the company has been functioning, he may initiate proceedings for inquiry under 206 and thereafter can take the company to status of active company. This is important. Rule 8. If you remain dormant for a period of 5 consecutive years, you will be striked off. And this is normally which we have seen, that if you fail to comply with the requirement of this section, by default, your name will be striked off from dormant company. Striked off from dormant company. So this is important. Can a dormant company be striked off? The answer is yes. Or when it fails to comply with the requirement of this section, the company may be struck off. So both scenarios. Not filing return and failing to comply with the requirement of this section. So this is all about dormant company, strike off, and finally we come to the punishment for fraud. Punishment for fraud. Very harsh provision. Excuse me. Yes. So punishment for fraud. Very dreadful provision for all the people who are involved in running the company. So punishment for fraud is, and in exam, practical question may come. Practical question may come to understand how much penalty can be levied. Without prejudice to any liability, including repayment of any debt. So, if there is a liability which includes any repayment of debt, without affecting those provisions, without prejudice to that particular these events, any person, remember, it's not only about directors, managers, KMPs, any person who is found to be guilty of fraud involving an amount of at least 10 lakh rupees or 1% of turnover, whichever is lower. So at least there should be a minimum amount of this, whichever is lower, he shall be punishable, whichever is lower out of these two terms. And the amount should be of minimum 10 lakhs or 1%. Whichever is lower, that amount. So if 1% of turnover is 8 lakhs, so the fraud should be of minimum 8 lakhs. If the turnover is, let's say, 100 crore, so 1% is 1 crore. Then if the fraud is of 10 lakh, shall be punishable with imprisonment for a term which shall not be less than 6 months but extend to 10 years, and fine not less than the amount involved in the fraud but may extend to 3 times. So from the amount of fraud till 3 times, maximum 3 times the X. That is first. Second, if the question involves public interest, the imprisonment, which is 6 months, should be minimum 3 years. Amount remains same. Third, a change in the amount. The fraud involves amount less than 10 lakh or 1% and no public interest. imprisonment from 10 to 5, and fine is only 50 lakhs, maximum 50 lakhs, or with both, So there are three scenarios which have been built in. Now, what does fraud means? Fraud means act, omission, concealment of any fact, abuse of position committed by any person or any other person with the convenience in any manner. So there are four things: act, omission, concealment, abuse. And the intent is to deceive, to gain undue advantage from, or to injure the interest of the company or its shareholders or creditors. So you want to deceive, have to take an undue advantage, or you want to injure all the interest of these company shareholders and so on, whether or not there is any wrongful gain or wrongful loss. That is immaterial. Whether you have gain or loss, that is immaterial. Finally, the intent was to deceive. Wrongful gain means the gain by unlawful means of property to which the person gaining is not legally entitled. He was not entitled for that gain, but he has got that gain. Wrongful loss, even if there is loss. So you cannot argue that I have incurred a loss because of this, so I should not be levied a penalty. So under both the scenario, because your intent was to deceive, to gain an undue advantage which you did not get, that's a different question. And the event was to act in such a manner, omit in such a manner, conceal in any manner, or you want to abuse your position, being a director, managing director, chairman, whatever the case may be. So here, the fraud is a very generic term. So because it has become a very generic term, at times it is difficult to prove, and at times it is very easy to blame upon. It can be both the scenarios. So careful steps, action have to be taken before taking any step from your end if you are involved with any company. So the table, if this table gives you further clarification. So amount involved in fraud, at least lower of 10 lakhs and 1%, at least lower of 10 lakh and 1%. Public interest, no, yes, no. So wherever it is yes, we know it has to be more, from minimum 3 years to 10 years. And 3x of the amount involved and 3x of the amount involved. Penal amount, the fine amount remains same. Up to 5 years, if the amount is less than 10 lakhs or 50 lakhs or both. Or 50 lakhs or both. Probably this screenshot, if you take this, will give you enough, I think, the crux of the fraud and the penal provision. This is the whole crux of the fraud and the penal provision. Uh, 448 and 450, there are two sections. 450 is something. Let us take 448. So if in any return, report, certificate, financial statement, prospectus statement, or other document required for the purpose of any of the provisions of the Act, any person makes a statement which is false in any material particulars, knowing it to be false, which omits any material fact, knowing it to be material, that means deliberately. The intention is malified. That is the difficult question which you have to prove. So if you give a certificate, if you give any return, if you issue a prospectus, you are certifying something as a chartered accountant also. then you have to be aware of these provisions. So if you commit a false statement, then the punishment will be with respect to 447. Any false statement will lead to 447. And 450, where nothing is mentioned, apply 450. So if in a particular section no penalty has been mentioned, then if they want to levy penalty of 10,000, and in case of continuing contravention, 1,000 for each day. Maximum is 2 lakhs, and for an officer in default, 50,000. So this is a residual clause for the penal provision. Residuary clause for a penal provision. So friends, fraud 447, 450 residuary clause. Remember, there may be a question where contravention has been made and the section will say, there's a contravention of this section, how much penalties should be levied? So then you have to refer to that section, and when the section will not talk about any penal provision, then you can generalize and apply the residuary penalty clause from 450. That is how you have to give the answer to that particular question. Okay, so let us now move on to our final topic, Nidhi companies. So Nidhi or mutual benefit society means a company which is central government may notify by notification of the official gazette declared to be Nidhi or mutual benefit society. That means to call a company a Nidhi company, an official gazette has to be seen, which will come from the central government, where they will mention this company is a Nidhi company. So apart from the section, we have to refer to Nidhi rules also, which is more important. There are various rules which we have to understand. Some of the rules are quite common, which relates to the banking world also. But then something which are specific that we have to see and read. So section 406 is definition. Now going on to the rules. Nidhi rules 2014, because section is very simple. It does not talk anything more. So starting with the definition. Nidhi means a company which has been incorporated as a Nidhi with the objective of cultivating the habit of thrift and saving among its members, receiving deposit from and lending to its members only for their mutual fund, and which complies with the regulations made under the central government. So, friends, you must have seen there are a lot of small banks, cooperative banks. Now, are they Nidhi companies? So they are registered under this Cooperative Society Act. Similar function is performed, but this company is in the form of a company and they are registered under the Companies Act. So there are cooperative societies, there are cooperative banks, and there are Nidhi companies. All more or less perform the same kind of function. All more or less perform the same kind of function, except for the cooperative society, which may have a different objective, but cooperative bank and Nidhi companies, they fall under the same category, more or less. Governing body is different, the access, the reach is different. And if you look at the Indian demography, you will understand because the nature is similar. So you may find Nidhi companies prevalent in northern India and cooperative bank prevalent in south and western part of the country. So maybe there is only a structural difference, but as the objective remains same, some form has been created somehow so that the common man gets the benefit out of such structure. So if the Nidhi, the objective is very clear, they will cultivate the habit of thrift and saving, small savings. Thrift and small saving means small savings among its members, receive deposits and lend. So they will accept deposit and lend to its members only. Nidhi companies shall be a public company, first thing. Then minimum paid up equity capital of 10 lakhs. Minimum paid up equity capital of 10 lakhs. They cannot issue preference shares. They cannot issue preference shares. Good. And if they have been issued, they will be redeemed. So objective is very clear. This should be mentioned in their MOA. Mentioned in their MOA. And every company incorporated as Nidhi shall have the last word Nidhi Limited as a part of its name. Every Nidhi company shall, within a period of 1 year from the commencement of this rule, ensure that it has not less than 200 members, first condition. Net owned fund of 10 lakhs or more, second condition. Unencumbered term deposit of not less than 10%. Free from anything. Term deposit should be free of the outstanding deposits. And ratio of net owned fund to deposit of not more than 1:20. Exam question. Condition. Then certain requirement for filing of certain forms, NDH, within 90 days from the close of first financial year. After its incorporation, wherever applicable, the second financial year, the Nidhi shall file a return of statutory compliances. So they have to comply after the first financial year, after this incorporation, or within 90 days, let's say by the time the second financial year starts. In that case, within 90 days from the second financial year, they have to file this form. And if they are not complying, they will file for an extension. That's simple, nothing to be discussed. Now, certain amendment which has been done, that was initial. Now, the net owned fund should be 20 lakhs. The number of members should be created within 120 days. Within 120 days. Prohibition that they cannot do these kind of action. Carry in the business of chit fund, hire purchase, leasing, finance, acquisition of security issued by any body corporate, not allowed. Issue preference shares, not allowed. Open any current account with its members, not allowed. Acquire any other company by purchase of securities or control of the composition of board of directors, not allowed. So these are restrictions, which actually highlights that Nidhi company is here for a specific objective. Nidhi company is here for a specific objective. So exam question, what are the perform actions not allowed by Nidhi companies? Then carry on any business other than business of borrowing or lending in its own name. Pledge any of the assets lodged by its members as security, except deposit from or lend to any person other than its members. Take deposits from or lend money to any body corporate. Enter into partnership agreement. So it is for the members by the members. So you have to remember these 10 points for getting that 4 or 6 marks. 4 or 6 marks. They cannot raise loan from bank and FIs for lending to members. So even if they are lending to members, they cannot raise a loan and then give it to members. No, not at all allowed. Example, Sunshine Benefit incorporated as Nidhi company. Board decided to provide locker facility on rent to its members and have estimated that rental income from such letting would be 25% of the income. Examine the validity. So whether locker rent is allowed or not, the answer is yes. According to rule 6, rental income from locker is allowed, but not exceeding 20% of the gross income of Nidhi at any point of time. So that is to be noted. That is to be noted. So at any point of time, if this income exceeds 20%, so not at all allowed. Something with respect to share capital should not be less than 10 rupees. And every Nidhi shall allot to each deposit holder at least minimum of 10 equity shares or equivalent to 100 rupees. And a saving account holder and a recurring deposit holder should at least hold 1 equity shares or rupees 10. So these are certain basic conditions for share capital. So they have to give to each deposit holder and each savings account holder and recurring deposit holder some amount of shares. Then they shall not admit a body corporate or trust as a member. That's fine. Yes, net owned funds, that is 20 lakhs. That is important. Please remember, that's a change which has happened. Branches, they open a branch only if it has earned net profit after tax continuously in the 3 financial years. So again, a condition, please do remember from exam point of view that they have to earn profit. Then only they can open up the branches. Maximum 3 branches per district. A lot of restrictions where, so I wonder that why these Nidhi companies are created. But when we go to the northern side, you'll find that so many things, so many companies are there in the form of Nidhi companies. Then the amount of deposit, it should not exceed 20 times of its net owned fund, and minimum net owned fund is 20 lakhs. So minimum it should start with, it should not exceed. So if minimum it is 20 lakhs, so 20 times is 20 lakhs is 400 lakhs, that is 4 crores. Then fixed deposit shall be accepted for a minimum period of 6 months and maximum period of 60 months. Recurring deposit shall be accepted for a minimum period of 12 months and a maximum period of 60 months. In case of recurring deposit relating to mortgage loan, the maximum period of recurring deposit shall correspond with the repayment period. So I wonder if these questions are asked in the exams. You need to remember all these things because these are all straightforward things. I mean, nothing to explain because these are rules and rules have to be followed. There's no such complication involved in these rules. Yes, something with respect to loans. Let us understand that. So what is with respect to loan? Nidhi shall provide loan only to its members. Taken, accepted. The loans given to Nidhi members shall be subject to following limits. 2 lakh rupees, where the total amount of deposit of such Nidhi from its member is 2 crores, less than 2 crores. 7,50,000, where the total amount of deposit is more than 2 crores. 12 lakh, 15 lakh. So slab is 2, 7.5, 12 and 15. This is the slab. So please remember the slab table. 2, 7.5, 12 and 15. This may be asked in exam. This may be a possibility. Just excuse me for a minute. So something on share capital, something on amount of deposit. These are questions which can be asked in the exams. Again, a small point, but then if the paper has to be tough, then these are the ways to make the paper tough. So if the Nidhi has not made profits continuously in the 3 preceding financial years, it shall not make any fresh loan exceeding 50% of the maximum amount of loan. So in case of loss, there is certain limitation with respect to the loan which the Nidhi company can give. And if a member has made a default, further loan shall not be given to that person. Property against loan, against gold and jewelry, immovable property, and the mortgage loan, basically the total loan against immovable property shall not exceed 50% of the overall loan outstanding on the date of approval of the board. So against immovable property, there is certain limitation which the board has to take care of it. Rate of interest, yes, very important, shall not exceed 7.5%. So when there is a cap on the interest rate, there is a cap on the amount of fund raised, then for what purpose is this being carried on? Is there any profit element? So friends, the objective is to cater to small people. And because there is only saving and current account, there is always a margin. So people who want to go for small people, reach out small people, probably these Nidhi companies are beneficial. But nowadays, small banks have been opened up, microfinance banks are there. So these Nidhi companies are losing their sheen and shine. Directors may hold office up to 10 years, shall be reappointment after expiration of 2 years of ceasing to be a director, and so on. Again, quite normal. Dividend declaration, yes, it cannot declare dividend exceeding 25%. And for that, certain conditions are to be fulfilled. Amount has to be transferred to general reserve, no default in repayment of matured deposit, and has complied with all the rules applicable to Nidhis, which has been deleted now. Yes, for an auditor, I think general provisions, not a major, nothing to be taken care of. So, no Nidhi company shall appoint or reappoint an individual as auditor for more than one term of 5 consecutive years. And no Nidhi company shall appoint or reappoint an audit firm for more than 2 terms of 5 consecutive years. So, as an individual, 5 years, firm, 10 years. Then half-yearly returns, penalty for non-compliance, and so on. Let us see any question. Swani Nidhi Limited proposed to reappoint Mr. Hemant. The director has completed a term of 10 consecutive years as a director of Nidhi company. Comment on the validity of the above proposal with reference to Nidhi rules. So as per the rule 17, director shall hold office for a term of 10 consecutive years. Then there should be a gap of 2 years. And once there is a gap, then he can be reappointed. So that is what you have to explain. So I think within Nidhi companies, few provisions, if you are able to remember, that would be great, fine. Apart from that, I think you can take a risk on these subjects sometimes, looking to the overall content, the learning, even the question may be direct, but the effort which will go in learning may have to be evaluated. And if you have sufficient time, definitely you should learn this. If you have limited time, refer to those relevant points, grab those points and make a list of these. That's all. So friends, today we have covered various parts, multiple things, from registered valuer, from being a registered valuer, going back to that point of registered valuer. Remember who can be a registered valuer. That is important, that you have to learn. The qualification and experience required to be registered valuer. What does 247 says? The penal provisions in 247. Then the contents of the valuation report. And as a registered valuer, individually, what is your qualification? And as a partnership firm, what is your qualification? What is the minimum condition? Eligibility conditions, not a qualification, eligibility condition. Qualification and experience are listed separately. So eligibility condition, qualification, experience, 3 things. So 247, eligibility, qualification, experience, contents of the report. 5 important things. 5 important things to be remembered from exam perspective. Then strike off 248, 249, 252. 248, 249, 252. 3 things to remember. 248, remember 248 is all about striking off by registrar and company both. Registrar and company both. 249, it's the conditions under which you cannot apply for striking off. So restrictions. So under which of the scenario you cannot apply for striking off. And 252 is restoration. 252 is restoration. Then difference between dormant company, striking off, winding up, conditions for dormant company, when you can classify dormant company, restrictions when you cannot apply to be a dormant company, and restoration from dormant to active. Restoration from dormant to active. So that is with respect to dormant companies. Government company definition, which companies can be classified as a government company, that is important. And the compliance part, being a government company, what is the compliance to the parliament and to the legislative assembly. For 447, the amount of quantum of fraud, that table which I have shown, that table may be important. So you can learn that table, the quantum of fraud, definition of fraud, quantum of fraud, penal provision of the fraud, and definition of fraud. Three things: quantum, penal provisions, and definition of fraud. Then, if nothing is mentioned in any act, 450, the residuary clause of applying the penal provision. Residuary clause of applying the penal provision. So these are the sections. I think this is enough for today, because as it is only miscellaneous provision, so nothing major to be covered. So small aspects, small topics, grab those important points and take away 4 to 6 marks. So I think there's not much of questions which have been asked today. Somehow the questions are missing. So if you have any further doubt, definitely you can connect anytime, raise your point. Raise your point. And we can discuss it in our next class. So I'll be joining on 23rd to cover the topic of SEBI, and very important chapter, SEBI. So don't miss out on that. So thank you and see you on 23rd.